Nio Inc. ADR is currently trading at $5.10 USD on the NYSE, showing a sharp intraday decline of 40 cents, which translates to a 7.27% drop today. This immediate downward pressure comes as a surprise to many who are looking at the massive delivery numbers just released for the end of 2025. While the surface-level data looks like a success story, the market is reacting to something far more structural. Most investors expected that hitting a record-breaking 48,135 deliveries in December would propel the stock upward, but the reality is that the market is now questioning the cost of that growth. The common belief is that NIO is finally finding its footing by diversifying into the mass market with its Onvo and Firefly brands, but the deeper reality suggests that this expansion is stretching margins thin at a time when competition in the Chinese electric vehicle space is becoming a war of attrition. We are seeing a classic example of the market pricing in the how rather than the how many. It is no longer enough to just deliver cars. The street wants to see a clear path to profitability that does not rely on constant capital injections. If you look at the recent trading volume, it has been unusually high, signaling a significant handover between different types of investors. While retail traders on platforms like the Robinhood app or through their individual brokerage accounts might be drawn to the low share price as a value play, institutional activity shows a more cautious stance. Big players using sophisticated tools like the Interactive Brokers platform or managing assets through Fidelity Wealth Management are closely watching the vehicle market, which recently sat near 13.9%. This is a notable improvement from earlier in the year, yet it remains below the 20% threshold that many analysts believe is necessary for long-term sustainability. The high beta of NIO stock means it often moves with more intensity than the broader market, which is why we are seeing such a violent reaction to today's news compared to the relatively stable movement of Nvidia stock or Apple stock. When we look at the institutional landscape, we see a complex mix of sentiment. Some funds are adding to their positions, treating this as a long-term play on the inevitable shift toward electric transport. Others are trimming, perhaps moving capital into safer bets like Fidelity ETFs or dividend-paying assets. The contrast in strategies is stark. For instance, those who engage in self-investing might see the current price as a gift, while those following the automated guidance of a Schwab Intelligent Portfolios or a SoFi robo-advisor might find their allocations shifting away from high-volatility international ADRs. This tension between the growth-at-any-cost crowd and the profitability-now crowd is what is driving the current 7.27% slide. The delivery numbers for the full year 2025 reached 326,028 vehicles, a nearly 47% increase year over year. In any other environment, that would be a victory lap. But today, investors are looking at the cash burn and the impending 2026 profitability target that management has set. Before we continue with the breakdown of the business model, I want to hear from you. Comment below how many shares of NIO you currently hold and what your average cost basis is. It is always interesting to see where the community stands on these volatile growth stocks. The core of the NIO business model has always been its battery swap technology. This is their primary differentiator against competitors and even against Tesla stock. With over 3,000 swap stations now operational, NIO has built a massive infrastructure that theoretically makes charging as fast as filling up a gas tank. However, the cost of building and maintaining this network is immense. While analysts suggest the battery swap business could break even by the end of 2026, that assumes a high utilization rate that hasn't quite materialized yet. Each station needs an average of about 60 swaps a day to start paying for itself. Right now, many stations are operating well below that. This infrastructure is a double-edged sword. It creates a sticky ecosystem for users, but it acts as a massive anchor on the balance sheet. Beyond the flagship brand, the company is betting big on its multi-brand strategy. The Onvo brand is designed to take on the mid-market segment directly, offering a more affordable entry point without sacrificing the battery swap capability. Then there is Firefly, the smaller, more compact brand intended to capture the lower-priced urban market. This strategy is a direct attempt to move away from being just a premium player and into a mass-market volume leader. The logic is that higher volume will eventually lead to lower per-unit costs and better bargaining power with suppliers. But as we saw in late 2025, launching these brands requires massive marketing spend and research and development costs. The company has tried to cap its research and development at 2 billion yuan per quarter, but staying ahead in autonomous driving and battery technology is expensive. If you are using online investing tools or browsing investing sites for your next move, you have likely noticed that NIO is often compared to its domestic rivals like Li Auto or BYD. Unlike NIO, some of these competitors have already achieved consistent profitability by focusing on plug-in hybrids or more traditional manufacturing scales. NIO's insistence on the battery-as-a-service or BaaS model is a bold bet. It allows customers to buy the car without the battery, lowering the upfront price and then paying a monthly subscription. This helps with the initial purchase decision but creates a long-tail financing requirement for the company. It's a recurring revenue model in an industry that has traditionally relied on one-time sales, which is why it attracts interest from those looking for intelligent portfolio diversifiers. Recent macroeconomic pressures cannot be ignored. The Chinese economy has been through a period of cooling, and while trade-in subsidies helped boost the 2025 numbers, those tailwinds are starting to fade. Furthermore, the global trade environment is becoming increasingly hostile toward Chinese-made vehicles. With high tariffs in the US and the European Union, NIO has had to pivot its strategy in Europe, moving toward a lighter asset model by partnering with local distributors rather than going it alone. This reduces risk but also cuts into potential margins. Investors using interactive brokers trading or Fidelity brokerage to access international markets are rightly concerned about how these geopolitical tensions will limit NIO's total addressable market. Looking ahead to the rest of 2026, the catalysts are clear, but the risks are high. We are expecting the launch of several new SUV models, including the ES9 and the Onvo L80, which are supposed to drive volume in the second half of the year. The company is also moving towards its fifth-generation battery swap stations, which are promised to be more efficient and compatible with other manufacturers. If NIO can successfully sign more partners to its swap alliance, the infrastructure could transition from a cost center to a genuine industry standard. However, the reality is that no major partner has yet launched a mass-produced model that uses NIO's swap system, despite years of agreements. This lag between partnership and product is a major source of skepticism for institutional investors who manage Fidelity mutual funds or work within Fidelity IRAs. The expectation was that the 2025 delivery surge would provide a safety net for the stock price. The reality is that the market is looking through the sales numbers and focusing on the underlying financial health. The drop to $5.10 today reflects a show-me attitude from the street. They have seen the growth, now they want to see the gain. Whether you are using the Robinhood mobile app for quick trades or the interactive brokers platform for deep analysis, the conclusion is the same. NIO is at a crossroads. It has proven it can build and sell world-class electric vehicles at scale, but it has not yet proven it can do so profitably in a crowded, competitive market where price wars are the norm. For those involved in online investment or seeking investment help, the question is often about timing. NIO remains a high-risk, high-reward play. It does not offer the stability of a Fidelity wealth management portfolio filled with blue-chip stocks. Instead, it offers a bet on a specific vision of the future of transport. If the battery swap network becomes the gas station of the electric age, the current valuation will look incredibly cheap. If it remains a niche system used only by NIO owners, the capital requirements may eventually force another dilutive equity offering. We have seen the company raise billions through share sales before, which is always a concern for those holding an individual brokerage account. In summary, today's 7.27% drop is a reaction to the tension between impressive delivery volume and the harsh reality of the competitive and financial landscape in 2026. The expectation was a post-delivery rally. The reality is a margin-focused sell-off. NIO is successfully expanding its brand portfolio with Onvo and Firefly, and its battery swap network continues to grow, yet the path to non-GAAP profitability remains a narrow one. one. Institutional sentiment is split, with high-volume trading suggesting a major reevaluation of the stock's risk profile. As we move further into the year, the success of the new models and the potential break-even of the swap business will be the primary factors to watch. For now, the market is sending a clear message. Growth is good, but sustainability is better. Whether you use SoFi Invest, Fidelity Trading Platform, or any other investing sites, keeping a close eye on the vehicle margins and institutional net flows will be essential for navigating the volatility that NIO is famous for. The company has reached nearly 1 million cumulative deliveries, a massive milestone, yet the stock price reminds us that in the world of high-growth tech, the past is just the prologue to the next quarterly report. The contrast between the record-high deliveries and the current price action is a perfect illustration of how the market prioritizes future cash flows over past achievements. Investors are no longer satisfied with the narrative of